Good afternoon. My name is Josh Humphreys. I'm President and Senior Fellow of Croatan Institute, and I'd like to welcome everyone to Durham, North Carolina, to the inaugural Croatan Forum. It's a real privilege and honor to have Laura and Jim up here with me. Those of you who are local probably know who these folks are. Those of you who are not, I'm really pleased to introduce them together here. I'll begin with Jim, who is the president and CEO of Mechanics and Farmers Bank, or M&F as it's often known, a real pillar of Black Wall Street here in Durham, and now a community development financial institution bank, the only CDFI bank, I believe, in North Carolina, if I'm allowed to say that?
Yes, we're the only commercial bank in North Carolina that's actually a commercial bank and a CDFI institution also.
Yeah. And on my left is Laura Benedict, who is the recently appointed president of SelfHelp Ventures Fund, which is part of the broader SelfHelp family that has been a very important community development financial institution itself, which includes a credit union. Indeed, I believe now the nation's largest credit union that is a certified CDFI that was founded here in Durham. Laura presides the Ventures Fund, which is a certified CDFI loan fund. So to bring together two neighbors from downtown Durham, the leaders of these really important bulwarks to the community, is a real honor. And so I just want to thank Jim and Laura for being here today and welcoming so many people to Durham with a real Durham show of force. At the same time, you know, SelfHelp and M&F have very different histories and backgrounds. And I think what we're really interested in doing today is having a conversation about the future of community finance from two very different community financial institutions with different regulatory frameworks, different histories, different missions, different lending operations. And that's really the nature of the conversation we'd like to have. We've got about 45 minutes for this conversation. Our hope is to have a conversation really with Jim and Laura first, and then turn it over to you in the audience. And as you can see, Full Frame is a very intimate setting, and we have explicitly designed the forum to avoid having any small group breakouts. And we've done that so that we can keep people in the same thread of the conversation over the course of these days to really put a premium on discussion among us. So know that all of us are part of this conversation, so we look forward to moving through that, and I'm hopeful that my team will move me in that direction today. But I'd like to just begin the conversation by turning over to Jim and having you tell us a little bit about M&F, the background, the history of M&F, and what kind of work you do here in Durham and across the state.
Again, good afternoon, everyone. Welcome to Durham, and I just want to congratulate Josh on your first forum. That's right. That's a great accomplishment, and we're looking forward to many more, right? Okay. And I also like to just give my special shout out to Laura. So it's an honor to be out on this panel with you. I've never met Laura previously, and she works right around the corner from our bank. Our bank's been in business for 110 years. We're the second oldest African American owned bank in the United States. It was founded in 1907. I've been the CEO for about 4 years. We're $260 million in total assets, but the bank has a very rich history. It was founded right around the corner on Paris Street, and you've heard probably lots of references to Black Wall Street. And so that particular street had Mechanics and Farmers Bank, North Carolina Mutual, a mutual community savings bank, and there were a lot of other ancillary businesses that were actually on that street. And people from Booker T. Washington to presidents of the United States to politicians used to come down that street because they wanted to know what was going on in Durham. Why is Durham so special to have 3 financial institutions on the same street? So that's how it got the nickname of Black Wall Street. We have some very loyal customers, very loyal shareholders. I've worked in a number of community banks all across the country, and I've never seen a more loyal customer base. And we've had customers that have banked with us for 40, 50, 60, 70 years, 80 years. And some churches and organizations that have actually banked with us for a long period of time. The bank throughout history has been involved in the community. It's made church loans, business loans, loans to allow the Durham residents to go to, their kids to go to college, business expansion loans. And one of the things that the bank did, it said it really wanted to partner with people who had recently graduated from HBCUs. And so we're an urban bank, and we're located in the 5 largest markets in North Carolina. So those 5 largest markets are Charlotte, Raleigh, Durham, Winston-Salem, and Greensboro, and they all have HBCUs and HBCU alumni. And so one of the strategies was to try to make sure for the bank to sustain itself that it targeted that type of consumer, because they felt that that would allow the bank to sustain itself. And that strategy has worked for 110 years. We're a community bank. We service everybody. We have customers from large financial institutions to even including SelfHelp. So I'm excited to be here. I feel really good about what we're doing. And I was really brought in to kind of transform the bank, and I'm going to talk about that a little later.
Great. Thanks so much, Jim. Laura, tell us a little bit about SelfHelp, and for those of you who may know SelfHelp, you're probably always perplexed and surprised by its complexity. Laura runs a venture fund that's not a venture capital fund, for example, and so I think it's a real privilege for us to hear straight from leadership, what the SelfHelp family is all about and the role the ventures fund plays. And I'll just make a personal note here early on. Is, if I understand correctly, SelfHelp made its first loan to a bakery in my hometown of New Bern, North Carolina, which some of you may have noticed has been in the headlines recently. So I'm really intrigued by this different kind of history, one rooted in Black Wall Street, going to the era of Reconstruction and Emancipation, to a much more recent creature of the community development finance space, one that started out making small loans in Eastern North Carolina to become now one of the largest CDFI credit union complexes in the country.
Great. Well, thank you, Josh. It's a pleasure to be here, and again, welcome to Durham and to American Tobacco Campus. So compared to M&F, we are a teen, but we're actually almost 40 years old. So for a little upstart nonprofit, we're have some maturity on us. We were founded in 1980 by a young couple, Martin Eakes and Bonnie Wright. They were very inspired by the successes of the civil rights and women's movements, and wanted, when they finished their schooling, to try to have impact of these movements in the economic arena. Today, almost 40 years later, we're almost, actually a little bit over a $2 billion institution, combining all of the different parts. And we are a CDFI, and I just thought some of you, I think most of you know what a CDFI is, but just in case not, it's a private financial institution that's 100% dedicated, like M&F and SelfHelp, to delivering responsible, affordable lending to help low income and or low wealth and or other disadvantaged people and communities join the economic mainstream. So, what does SelfHelp do? And how? We operate on a nonprofit basis. That's one of the difference between M&F. You are a different model, commercial bank. And we are not all 501c3s, but none of our strategic institutions are for-profit. Some are for holding real estate, but that's limited. Through the year 2017, we have delivered over $7 billion in financing to 146,000 families, individuals, small businesses, nonprofits. 78% of those are to low-income borrowers, 74% to people of color, 38% to women, 34% to rural, and 68% to underserved communities. As Josh was saying, I'm the president of our SelfHelp Ventures Fund, newly appointed. Those of you who know SelfHelp probably know Bob Schall, who was the founder and CEO or president of the Ventures Fund for 34 years. He retired this spring, and I was fortunate to be invited to take over from him. It is a loan fund. It is a 501c3 charitable organization, and it really serves as not as a venture capital fund, despite the name, but as a holding company for a lot of SelfHelp's assets. So the Ventures Fund itself has about $800 million with which we provide loan capital for commercial lending, debt and equity to develop real estate, primarily in North Carolina, but we've got some holdings in Washington, D.C., and are looking to expand where we have credit union branches, to purchase affordable home loans, serving in essence as a secondary market to conventional banking players. And our last aspect of being a holding company is that we pass through subsidized equity type capital to scale up our credit unions. Josh mentioned the credit unions briefly. We have actually 2 different credit unions. For regulatory reasons, it's helpful to have somewhat different structures. So our founding credit union started in 1984 with $77 from bake sale from the New Bern Bakery. Is a state chartered credit union, and in 2008 we formed the SelfHelp Federal Credit Union, from a borrower perspective, it may not necessarily make a big difference, but it helps us. The majority of my almost 30 years at SelfHelp, I started in 1989, was spent on the commercial lending team, one of the key components of the Ventures Fund work. I started as a loan officer, and my territory was rural southeastern, North Carolina. One of my favorite loans still was to a Native American Lumbee entrepreneur who wanted to create a concrete batch plant. First American Concrete was the name in Pembroke, and that had a really good run for a number of years. I developed our lending program for childcare providers, not a particularly big business necessarily, but a key part of community development. And I led the commercial lending team for almost 10 years, during which time we made, for example, the loan that helped create this American tobacco campus. In the early 2000s, Capital Broadcasting had purchased the Durham Bulls baseball team, AAA now baseball team, and were interested in redeveloping this huge campus. And they couldn't find financing anywhere. And believe me, we encouraged them to try because we were terrified of it. But we were really the lender of last resort. The New Markets Tax Credit Program, which is a federal initiative out of the Department of Treasury, had just launched, and we had a nice big chunk of capital as a result of that. We were able to make a $40 million loan to this very questionable investment because downtown was a very different place back then. And anyway, it obviously was a good investment. I know some of you went on the tour with our loan officer at the time, Tucker Bartlett. Anyway, that's, I think, an example of the type of investment that a CDFI can make when others can't. So I now spend my time, as I wrap up this first part, raising and managing capital for SelfHelp, developing new programs, and helping measure our impact.
And really, ultimately, I want to move the conversation into the future, but before we do that, I just want to raise a recurrent theme that is animating this whole forum, and that is a retrospective look, a decade on since the financial crisis. And financial institutions, community financial institutions, were by no means immune from the turbulence of the mortgage meltdown and the financial crisis. And I would just invite Jim to reflect a little bit on how he's seen M&F come out of that as one of basically the top 20 black-owned banks. The mortgage meltdown was pretty challenging for the CDFI space. A lot of CDFIs actually collapsed in certain markets, in places like Chicago and in the Midwest in particular. And I think we're still seeing the aftermath of that. But tell us, how in the world did M&F survive that storm?
That's a great question. M&F actually had 108 straight years of profitability up until about 2 years ago. And the reason why I stated that is because I was brought here to clean up the balance sheet. We had some problem loans that actually originated in 2008, 2009, 2010, and 2011. And the bank and the board and the management team, they felt that they could weather through it and eventually correct the situation. So fast forward, I get here in September of 2014. The delinquency rate was extremely high. This is all public information. The delinquency rate was over 10%. But most of it was from loans that had been originated in 2007, 2008, 2009, et cetera. We weren't able to turn it around, so we made a decision to just clean up the balance sheet. So when other financial institutions were cleaning up their balance sheets in 08, 09, 010, and 11, a number of banks, financial institutions had losses. So our board, they wanted to just keep maintaining that streak of 108 years. So the last 2 years, we've just cleaned up our balance sheet. Our delinquency is less than 1%. We're a whole lot cleaner and healthier. And we also purchased a financial institution, Mutual Community Savings Bank, which was one of the pillars of Black Wall Street. And they had a bunch of problems. And so the problems we had on our balance sheet plus the problems of the institution that we acquired just compounded, we made it through, but they got more conservative. They started doing more church loans because they felt that was a loan that had been kind of their bread and butter product. Most churches do not default. We've only foreclosed on 3 churches in 110 years. But that's a very conservative kind of play. And so I would say we've weathered it, but it was very, very difficult. But we're here and we're doing very well today.
And how about on your side, Laura? I mean, you folks have a distinctive view on that, given the credit union structure, which is, as many of you probably know, if you know a little bit about banks, and credit unions, they come under a different regulatory authority. And maybe you can tell us a little bit about the credit union side in particular and how SelfHelp performed during the financial crisis and the kinds of M&A activity that you guys have experienced since then over the last decade.
Sure. So when the crisis hit, we pretty quickly went into a mode of trying to help our current borrowers stay afloat. And made relatively few new loans, unless they were loans restructuring existing loans to buy time while people tried to recover. We also stepped up to helping keep financial services available through primarily credit unions in low-income communities by using our resources that weren't now going out in new loans to buy or merge with oftentimes challenged financial institutions. So Josh mentioned M&A. We had just kind of coincidentally started an office in Northern California, driven more by our policy work. Those of you that were at the pre-session yesterday were in the headquarters for our policy and advocacy arm, the Center for Responsible Lending. We can come back to that later, but here we were in California, the financial crisis had hit, and there were a lot of small, very mission-oriented credit unions that were failing. They were being taken over by the NCUA, which is the National Credit Union Association Administration.
The equivalent of the FDIC for credit unions.
Exactly. So we looked at these institutions, and if we felt that they were mission aligned, compatible with being a CDFI, and if we felt that they had enough of a balance sheet or management, or ideally both, to be able to be turned around, we stepped in. So we have merged with or acquired 25 different financial institutions. Most of them are credit unions, 22. One check cashing business, and two banks, minority banks. Both of them are in Chicago. One is Seaway, which was one of our most recent merger acquisitions. Seaway was the largest Black-owned financial institution bank in the Midwest, and the financial crisis hurt them. They also suffered from a change of leadership and struggle really trying to bring in a good solid team. So none of these mergers and acquisitions have been power grabs or empire building or purely done on for a financial basis. So I was going to give an example of one that we merged with started in 2012, which was another bank, Second Federal Savings and Loan, also in Chicago on the southwest side of the city. And that bank, even older than M&F, it was started in 1882 as an immigrant bank, initially by Polish community. As Southwest Chicago evolved, it was more Ukrainian, and there may have been some other groups, immigrant groups, but by the time we came in to the mix, it was the largest community of Mexicans outside of Mexico City. So very Latino, Hispanic, Mexican basis. And, but it was hurting by the crisis. Their home loan delinquency was at 30%. So a local CDC, a really strong group called the Resurrection Project, or fondly known as TRP, was concerned. Many of their constituents were at risk of losing their homes and losing the local banking options. So they and the MacArthur Foundation, also based in Chicago, invited us to come in and try to help. We actually put in a bid to the FDIC for the institution, and it was rejected. I don't think they could imagine a credit union taking over a bank. So they ended up selling off the assets. It took some effort, but we were able to recombine them, and now the 3 branches in Southwest Chicago, still operating as Second Federal, a division of SelfHelp Federal Credit Union, is thriving. And we were able to keep 400 families in their homes that had the investors who initially bought the home loans, had them, they would have been foreclosed on right away. So.
That's great. So obviously there's been a lot of turbulence since the crisis, but we're in a different phase now. You know, we're 10 years on, 2 local, homegrown institutions here, positioning themselves very differently in many different ways based on their histories and their kind of service territories. Laura's kind of described already the complexity of SelfHelp as a family that I think is also part of the strategic innovation you're making in the field, right? You've got a nonprofit advocacy arm, the Center for Responsible Lending. You've got a CDFI certified loan fund. You have both a state chartered credit union and a federally chartered credit union that allows you to be in multiple geographies to help these other institutions. M&F, by contrast, is working in a place to which it has extremely strong ties. Yesterday there was a pre-conference event for our newly emerging REEFs initiative focused on racial equity, economics, finance, and sustainability, and it was a very important pivot pre-conference event from the activities of Black Wall Street homecoming last week. And legacy was a very important topic that arose repeatedly in those conversations. And it helps, I think, to understand the boundaries within which you are operating from a cultural perspective. I think another thing that came up yesterday, in the REEFs conversation, that is also another theme that's going to be driving conversations throughout the forum, is making issues of racial equity explicit in these conversations, even when we may not be having a panel or a session or a conversation devoted to racial equity investing, which we'll be doing tomorrow. And in much the same way that the forum is working at a very critical way, working at a critical way at these nexus issues that come up. So as I think you heard, Jim said it very quickly, but these two leaders have never met each other, even though they're neighbors. And Jim described the footprint of M&F as being in urban areas that also have historically Black colleges and universities. We have historically white and historically Black financial institutions as well as that, and sometimes that creates tensions and opportunities. So I think Jim also though mentioned that SelfHelp is a customer of M&F. So talk a little bit more about the future. Now that you've cleaned up the balance sheet and you've got some interesting trends on Black-owned banks and their numbers and where you think they're heading in the future. So tell me a little bit more about how you see the future shaping up for community finance.
Yeah. African American-owned institutions are really struggling in the aggregate. When I got in this business in 1991, we had 56 African American-owned institutions. Today, we're down to 19. And they have total assets of a little over $5 billion combined. I was brought here from Wilmington, Delaware to transform the bank. So we cleaned up the balance sheet, we brought in a whole new management team, we rebranded ourselves with new colors, new marketing material, we have new products. We invested in technology. I think one of the young ladies yesterday was asking me about technology. So we have mobile banking. You can apply to open up a deposit account with us online. You can apply for a loan online. We had to train our staff to be more sales focused and sales oriented. The culture at M&F, we've been around 110 years, and so people would just wait by the phone for someone to call them. So they did not have any kind of business development officer call program. And so I can just tell you from my experience of interacting with other African American owned bankers, most Black banks are going through this process of either making that decision of doing it the same way that they've been doing it the last 50 years or transforming themselves to be more aggressive to go after the markets and to more aggressively serve the markets where they're currently located in. And so 55% of our loans were to churches. Think about that. 55% of our loan portfolio was to churches. So they're just in the Durham, Raleigh, Charlotte markets, and even Greensboro and Winston-Salem, there's been unbelievable economic growth, especially in Charlotte, Raleigh, and Durham. And so we think it makes sense for us to tap into small and medium-sized businesses. We can lend to any one borrower up to $3.5 million. We're about $260 million in total assets, $240 million in deposits, and about $170 million in loans. And so now we've been really focused on operating companies. We think access to capital to small and medium-sized businesses will help the communities where we're located, because then you're recycling dollars back into the community. Those businesses are hiring people, they're expanding, and we think that's the future for an urban community bank such as ours.
Thanks. So how about on your side, Laura? I mean, what kinds of things are you doing with this complex entity that in many ways does bring together a flexible series of capital with the unregulated or lightly regulated debt vehicle with highly regulated depository institutions that now have a footprint that stretches across the upper Midwest, West Coast, here in North Carolina, as well as even further down in Florida. I know you have activities in the DC area. Where do you see the future of community financing from the self-help perspective?
Well, it's kind of ironic. In some ways, we are coming back to our founding roots. I think over the 2000s and 2010s, we have explored new markets, ended up with a large part of our loan portfolio, almost 90% of our home loan portfolio being in immigrant communities. Some of that's just a product of where the credit unions that we merged into and banks on the West Coast and in Chicago, it's just been a very, very robust market for us. So we have had for the last couple of years and will undoubtedly continue to have as a mission to increase our impact in African American communities. That's it's essential, both because that's a key part of our mission, and I think the financial crisis just decimated African American communities, especially. I was trying yesterday to verify this statistic, and maybe one of you know, but 1 in 5 households, African American homeowners, were negatively, majorly affected by the financial crisis. If they did not lose their home in foreclosure, the real estate value of their home went down because they were in neighborhoods that had a lot of foreclosures. And the pending, or actually current, student loan debt crisis is also another major obstacle. We're finding now, as we're trying to get back into doing more African American home loans, that it can take up to a year for us to work with somebody while they pay off other debt, work on accumulating modest savings for a small down payment, 3%, and finding a home, especially markets like Durham and a lot of places. Gosh, look at California. The real estate prices are just going skyward, and or they're just unaffordable, period. So those are some of the trends that we're experiencing.
Great. Jim, did you want to react to that real quick, or?
No, everything she said is completely accurate. I think it's really important that you remember a lot of those borrowers obtain adjustable rate mortgages, and they really didn't read the fine print. And they really didn't put any money down. And when the house lost value and they lost their job and the interest rate adjusted, that's how they got upside down. And that's what it was actually catastrophic in the African American community, because that crisis disproportionately impacted the African American community. And many of those communities are still trying to recover. Many of those consumers are still trying to recover to this day. Most African Americans, the majority of their wealth is the equity in their home. They don't have a lot of 401k and a lot of excess liquidity and CDs and money market accounts. It's really in their home. So one of our big themes is to make sure that we educate our consumers. And so we do a lot of financial literacy, we do a lot of outreach to make sure people understand the importance of credit, the importance of savings, the importance of having a financial advisor or somebody that you can speak to. And so we go out and we do a lot of that in the communities where we're located.
And this is going to be a recurrent theme. Our next session that Charlene Brown's going to lead is precisely around the complexity of financial inclusion and how you deal with the challenges of technology in this context, particularly with underserved communities, and the ways in which fintech is both an opportunity but also a bit of a specter for a lot of folks. So this dialogue is getting really fertily seeded right now. But let's turn it over to the audience. I'm going to grab one of these mics, and I'm not sure exactly, I haven't been schooled on how we're supposed to do it. I don't know, Christy, can you help me maybe? But I want to do this in a kind of orderly way. We've got about 15 minutes left, is that right, Christy? Yeah. And I think what I'd I'd like to try to do is let's try, this is a bit of an experiment for us, right? This is the first time we've done it. Let's take questions individually, let's hear them out and get folks to respond to them. That may not work in this context, and so we may have to bundle questions and then let folks opine on a kind of collection of questions. But let's try the individualized approach first, and just know that if that doesn't work for some reason, we're gonna rationalize it a little bit more so that we can maximize discussion, given that our time is limited. But I think Christian had his hand up, and just as a courtesy to the audience, please say who you are and your organization or role.
So my name is Christian. I live in New York, and I am a former institutional investor on behalf of a sovereign wealth fund, a life insurance company, family office, and I currently am a consultant for strategy. I'm going on the board of Berea College in Kentucky, and it's my connection to Berea that brings me here. And I just wanted to mention, Mr. Sills, a business opportunity I think I have for you.
Okay.
This morning I had a tour of this, the other part of this campus where they have 350 entrepreneurs, I think. Do you know the answer? Yeah, Harvard Underground. And the man who gave us a tour said, you know, we have one gap, we have one knowledge gap. Most of our entrepreneurs need personal financial consulting. And I think you mentioned last night that you need more millennial clients. And so I'd like to introduce you to your colleagues in America.
I love that idea. Yeah. Great, thank you.
I'm sure it happens.
Yeah. I see Ed's hand up there, and then Bonnie. Tell us who you are, Ed.
I'm Ed. I'm Ed Whitfield from Greensboro, North Carolina, fund for Democratic communities. I'd like to know, when you say you came to clean up your balance sheet, exactly what does that mean? In terms of, I might even know.
Sure. A lot of times banks, when they cannot bring a loan current, they make a decision to sell that asset to another financial party. And they'll normally sell that asset at a discount. So let's say it's a $100,000 loan that's delinquent. You've tried everything to bring the loan current. It's messing up your ratios on your balance sheet. So you may sell that loan for 85 or 90 cents on a dollar to somebody else. And so that's what that means, clean up our balance sheet. So we took some mortgage loans that we had, and we also had some business loans that had collateral, and we bundled them together, and we sold them to some additional financial parties that were not banks that buy distressed assets.
Did that typically result in foreclosures following the sale of the asset?
No, they will probably restructure those loans and give the borrowers maybe a little bit better terms, or they'll stretch out the amortization or give them a different payment structure for a year or so to give them more flexibility to work with them and then get them back to where they should be in terms of the correct principal and interest payment. But that happens every day in America, and it happened a lot in 09, 10, and 11.
Hi, I'm Bonnie Mullen-Brock, and I live here in Durham, and I'm a consultant in the impact investing space. And in relation to the issue of financial inclusion and the disparity of wealth in this country, it's a huge issue that both of your institutions have worked to address. And this notion of the role of CDFI to, I think the terminology, bring people who've been underserved into the economic mainstream. And you just had a conversation about the dependency on homeownership has historically been a strategy to help bring that up. And then in 2008, that again, disproportionately affected African American communities. So I'm curious from the CDFI perspective, when you think about addressing this disparity of wealth in this country, the role you see your institutions playing strategically, what the role is it home ownership, is it business with? I'm just curious as to what the thinking is after 2008 around how we build wealth in communities that have had those challenges that are separate from the
Yeah, we've been a CDFI since 2002, and I can tell you that we've received an outstanding CRA rating for over 30 years. So everything we do, we have that kind of lens on in terms of trying to help the communities where we're located. We're more focused on small business lending and not mortgages. We think that's the key to reduce the wealth gap, is to get capital into entrepreneurs who know what they're doing and who are trying to expand their businesses and also hire more people in their community. So we think that's the strategy for us. The SelfHelps of the world, the Wells Fargos, the Rocket Mortgage, the Quicken Loans, they have such an unbelievable market share in the mortgage market. We just cannot compete in that particular product. And so we think it's more on the small business lending and SBA lending, which will help the communities where we're located.
Jim, I'm going to take your mic and share it with Laura.
Thanks. Completely hear you about questioning homeownership as a strategy for community empowerment, but we still think it's the way to go. But we are putting more resources into trying to provide, taking from what Jim was saying, and I know we've done a lot of learning from LCCU. We're now experimenting with having financial coaches available to our members, folks who are just coming into the banking system or coming back in after financial challenges, and it's taking longer for people to be able to accumulate the ability to buy a home. But we still feel that home ownership is not any necessarily, I mean, you have to have the jobs which the small businesses bring about, and you have to have good policies. I guess the one other strategy that we're more newly employing around building wealth where there isn't is looking at other issues. We've gotten pretty involved in trying to fight bail bonding and living wage campaigns, so stuff that's not lending and traditional community development, but we're using some of our resources to try to address more basic fundamental policy issues.
Felicia Davis.
So when I walked,
Felicia, tell us who you are.
Felicia Davis with the HEC Green Fund, but when I walked in, I think you were mentioning that previously 55% of your business was with churches. And two questions. One, if those institutions are viewed as small businesses, is the first question. And then the second is around relationships, and I'm flashing back when I was younger, grandparents, parents had relationships with their banker, relationships, so it enabled a kind of flexibility that is nowhere available, not even possible for the big banks. But it seems to me now we've lost the expectation in the community to have that banking relationship. So it seems to me if you have a church base, how is that being leveraged for the educational piece and also building the relationships?
Great question, thank you. We've had relationships with churches for 110 years. Churches are not considered businesses. They're considered real estate, special purpose real estate. The members, tithe and they pay, the bills and all that. But we've been very successful in our church lending over 110 years. We've struggled to tap into the actual memberships. It really depends on the pastor. If he really wants to allow us access to the members, then it works fine. If they do not, you just can't get your foot in the door. To your second part of your question was related to relationship banking. And like I said earlier, we've had customers that have banked with us 30, 40, 50 years. Yes, they can pick up the phone, they can call me directly, they can call their branch manager, and we'll do whatever they say because we know them. And we track, most banks track the date open of that account or how long the relationship has been with the institution. And so, yes, we will deliver things to people's homes, we'll go pick up things for people's homes. We go the extra mile because in banking and in any business, you have to retain your customers and you have to deliver great service if you're going to retain your customers. And as I stated earlier, we have some unbelievably loyal customers. I've been doing this for a while. I've never seen customers this loyal. And I said this on our tour yesterday. It was drilled into generations of people that they had to bank with us. Parents don't do that today. But it was drilled in, you got to go to Mechanics and Farmers Bank. How come you haven't gone to Mechanics and Farmers Bank? But it just, it just takes more of that kind of, it just takes more people pushing that into the communities where we're located.
Charlene.
So I'm Charlene Brown with the Partnership Responsible Financial Inclusion. I'm curious as to how much each of your organization invests in capacity building or technical assistance for small and medium enterprises, because at least in my line of work, that's one of the keys to making those institutions much more successful.
Laura, you want to start?
Sure, I'd be happy to. Historically, and still, a lot of technical assistance is delivered in the loan application process. We say, send us your financials, and if they either can't do that or their financials are confusing, or we'll try to help them. Sometimes where we can, we will refer people to partner organizations. North Carolina has a pretty good set of small business technology development centers and small business centers at the community colleges. We have more recently been increasing our emphasis and awareness, especially with African American entrepreneurs, of the need for technical assistance above and beyond that. The woman sitting in front of you, Carmika Tillery Alston, who is on a panel later today or tomorrow, I'm not quite sure, today, was hired specifically to help us provide and source technical assistance for food entrepreneurs of color. We likewise, I think there was a discussion at yesterday's session. We're partnering with Project Runway and a boot camp in the Northern California around, again, in-depth technical assistance for African American entrepreneurs. So in conjunction with loans. But I mean, it's expensive. The loan revenue does not cover the cost of providing that TA.
And Jim, you're going to have the last word here.
Yeah, that's a fantastic question. We think we could do a better job of providing that technical assistance to borrowers. We do the same thing. We partner with the Carolina Small Business Development Fund. We also partner with Wake Tech, and there are other community colleges, and we also partner with SCORE. So there's a number of different organizations that we actually partner with. Whenever someone calls our bank and they want us to come out and say, how do I apply for a loan? How do I develop a relationship with a banker? We go out and we tell people, how they can establish a relationship with us.
Great. Well, join me, everyone, in thanking Jim Sills and Laura Benedict for beginning this conversation.